So, you spend 40 years of your life building up this retirement nest egg.
Right.
You skip the vacations, you drive the older cars, you diligently put a percentage of every single paycheck into a 401k. And I mean, you play by all the rules.
You do what you're told.
Exactly. But right now, the IRS has this hidden mathematical trap. A lot of research calls it a tax torpedo. And it's basically just waiting to detonate when you turn 73.
Yeah, and it's invisible.
Totally invisible. It is a trap that can spike your tax rate to over 40% overnight, and you can't even see it coming with the naked eye until it's way too late.
Which is terrifying for most people.
It really is. So we've spent the past week analyzing all the 2026 updates to IRS Publication 590B. We've been diving into analytical reports from T. Rowe Price and TIAA, parsing the latest research from Michael Kitz's map.
Really dense stuff in there, by the way.
Oh, incredibly dense. We pulled specialized financial planning data from Ameriprise and Covenant Wealth Advisors, too. And today, we are going to act as your specialized tax strategists. We're going to show you exactly how to diffuse that torpedo step by step in a process the industry calls tax-efficient decumulation.
Decumulation is it's a terrible word, frankly.
It is a clunky word.
It really is. But the concept itself is probably the most important financial shift you will ever make in your life. Because you spend a lifetime accumulating wealth, right?
Mm-hmm.
And that's actually the easy part.
Right, you just put the money in and wait.
Exactly. You invest it and leave it alone.
Mm-hmm.
But decumulation, actually taking the money out to live on that, is this intricate, highly sensitive maze. If you take the wrong dollar out of the wrong account at the wrong time, you don't just lose a little bit of efficiency.
No, it's way worse than that.
Right. You can trigger these cascading tax penalties that literally drain your portfolio a decade earlier than you planned. So the goal for our deep dive today is to make sure the IRS does not become your largest uninvited heir. I love that phrasing. Okay, let's unpack this. Because if you are listening to this right now, you want to be in control. You want to understand the actual mechanics of your own money. So we're going to start with the most pressing, imminent threat facing retirees today, the RMD Torpedo.
Let's lay out the foundation first.
Right. So the government gave us these amazing vehicles, right? The traditional 401k and the traditional IRA. We got a nice tax deduction when we put the money in. And it's been growing tax deferred for decades. But obviously, the IRS isn't running a charity. They want their cut eventually.
Yeah, I mean, it's essentially a loan. You made a deal with the government. They said, hey, we won't tax this money now, but we get to tax it later when you take it out.
Right.
The problem is most people just naturally assume that they get to decide when to take it out.
Which is completely false.
Completely false. The IRS enforces a strict timeline through what they call required minimum distributions, or RMDs.
Yeah.
Under the current rules, and these have shifted around quite a bit over the last few years, but they are lock-in for 2026. The government steps in at a very specific age and just mandates withdrawals.
So I'm looking at these IRS tables in Publication 590B right now, and frankly, it feels a bit like a shakedown.
It does feel that way.
It says if you were born before 1960, your RMDs begin at age 73. If you were born in 1960 or later, they begin at age 75. And it isn't even a flat rate.
Yeah, no.
They published this massive spreadsheet called the Uniform Lifetime Table, which dictates exactly what percentage of your account you literally must withdraw by December 31st every single year.
Yeah.
And it's based on your life expectancy.
It is a mathematically rigid system. So at age 73, you might have to take out roughly 3.6% of your total tax-deferred balance.
Okay.
But then by age 80, that jumps up to over 5%.
Wow.
And by 90, it's over 8%. So the IRS is systematically forcing that tax-deferred balloon to deflate so they can collect ordinary income tax on every single dollar that comes out.
And what if I just say no? I mean, what if I'm 75, I have plenty of cash in my checking account, I simply don't need the 401k money this year, and I just leave it alone?
Well, you really do not want to do that.
Why not?
Because the IRS does not view this as a polite suggestion. Failing to take your RMD, or even just miscalculating it and taking out slightly less than the exact dollar amount required, that triggers a 25% excise tax on the amount you failed to withdraw.
Wait, let me make sure I'm hearing that correctly. If the IRS formula says I need to take out $40,000 this year, and I just forget, they hit me with a $10,000 penalty right off the top.
Just as a punishment, yes.
That is insane.
It's one of the harshest penalties in the entire tax code. But
Right.
And here is the really critical piece that all of our sources highlight: the RMD itself, the actual forced withdrawal, that is not the torpedo.
Right, right.
The RMD is just the launch mechanism. The actual explosion happens when that forced withdrawal crashes into your Social Security benefits.
Yes, this is the part that completely blew my mind in the Savvy research. Most people walking down the street assume Social Security is tax-free. I mean, you paid into it your whole life through payroll taxes. So getting it back shouldn't be a taxable event.
It feels like it shouldn't be.
Exactly. But it absolutely is. And the formula the IRS uses to calculate that tax is just incredibly sneaky. It relies on this number called your combined income, which some planners call provisional income.
What's really fascinating here is how the government actively designed this formula to be confusing. Like if you ask a CPA what your income is, they will almost always point to your adjusted gross income, or AGI.
Right, the bottom line on the front page of your tax return.
Exactly. But to figure out if your Social Security is taxable, the IRS created an entirely separate parallel formula.
I actually have the combined income formula right here in my notes. I want everyone listening to visualize this. Your combined income equals your adjusted gross income, plus your non-taxable interest, which, by the way, feels like a total oxymoron.
Oh, it completely is.
They're literally taking interest from municipal bonds that is supposed to be tax-free and adding it back into this formula.
Yep.
And then finally, plus 50% of your Social Security benefits.
So they take half of your Social Security, add it to your AGI, add in your tax-free interest, and that creates your combined income score.
Right.
And once you have that score, you check it against the IRS thresholds to see how much of your Social Security gets taxed. And this brings us to one of the most egregious stealth taxes in American history.
Tell me about it.
These thresholds were set into law back in 1993, and Congress purposefully wrote the law so that the numbers would never, ever be adjusted for inflation.
Wait, 1993, so the thresholds we are using right now in 2026 to determine if retirees can afford their groceries are based on what a dollar was worth during the Clinton administration.
Exactly. And the sources point out this was essentially a brilliant political maneuver.
Also,
Well, if politicians vote to raise tax rates directly, they get voted out of office. But by freezing the thresholds in 1993, they allowed inflation to be the bad guy.
oh wow.
As inflation naturally pushes the cost of living up and retirees draw slightly more income just to survive, they get dragged over these static 1993 thresholds. It is a stealth tax increase that happens automatically every single year without a single politician having to vote on it.
That is just infuriating. So let's look at those actual 1993 numbers just so we know what we're dealing with.
Sure.
For a single filer, if your combined income is under $25,000, your Social Security is tax-free.
Right.
If it is between $25,000 and $34,000, up to 50% of your benefits become taxable. And if it crosses $34,000, up to 85% of your Social Security is subject to income tax.
And for married couples.
For married couple filing jointly, 0 to $32,000 is tax-free. Between $32,000 and $44,000 makes up to 50% taxable. And anything over $44,000 means up to 85% of your Social Security is tossed right into your taxable income bucket.
So let's ground this in reality. Let's imagine a hypothetical couple, David and Sarah. They are 74 years old. They live a relatively modest lifestyle. They get a good amount from Social Security, maybe $40,000 a year combined.
Okay.
For the first few years of their retirement, they were living mostly on that Social Security and pulling a little bit of cash from a standard savings account. Their adjusted gross income was tiny.
Because Social Security wasn't taxable yet.
Right. They were paying almost nothing in federal taxes. But now David is 74 and the IRS says, hey, David, you have $1 million sitting in your old 401k. You must take an RMD.
And the RMD at age 74 on $1 million is going to be, what, roughly around $40,000?
Roughly, yeah. So David is forced to pull $40,000 out of the 401k. That immediately spikes his adjusted gross income by $40,000.
And because his adjusted gross income just spiked, his combined income formula completely explodes.
Exactly.
Let's do the math. He takes his new $40,000 AGI, adds 50% of their Social Security, which is $20,000, and suddenly their combined income is $60,000. They just blasted right past that $44,000 threshold from 1993.
Precisely. They do not just pay ordinary income tax on the $40,000 they pulled from the 401k. That forced withdrawal basically acts as a magnet.
Right.
It's pulling previously untaxed Social Security benefits out of the safe zone and throwing them straight onto the tax return.
There is a staggering mathematical breakdown in the Kitz's research that illustrates this perfectly. They call it the phase-in zone. I really want to walk through this slowly because it is the absolute core of the torpedo.
It's crucial.
Let's say David and Sarah are right in the middle of that phase-in zone. David takes $1 extra out of his traditional IRA. just one single dollar. He clearly owes taxes on that dollar.
Right.
But because of the formula, that single dollar also pushes 85 cents of his Social Security over the line into the taxable category.
So the IRS looks at that transaction and says, well, you didn't just earn $1. You earned $1 from the IRA plus 85 cents of Social Security that is now taxable. You are now being taxed on $1.85 of income.
I do the math on that out loud just to make sure I'm not going crazy. If David is sitting in what looks like a totally normal middle-class 22% tax bracket, he takes out $1. The IRS taxes the $1.85 at 22%.
Yep.
22% of 1.85 is, okay, it's 40.7 cents. So for every dollar he pulls out of his own retirement account, he is paying 40.7% in federal taxes.
That is the tax torpedo. Your effective marginal tax rate spikes to an unbelievable 40.7%. Not because you are a billionaire, but simply because the mechanics of your 401k withdrawal are interacting toxically with your Social Security.
It's unbelievable.
And millions of middle-class retirees hit age 73 and are completely blindsided by this. They think they're in the 22% bracket, but they are bleeding cash at nearly double that rate.
But the sources warn us that this is actually a double blow. The Social Security tax is just the first part of the torpedo. The second part targets your health care.
Yeah, if we connect this to the bigger picture, we have to talk about Medicare. Specifically, a surcharge known as IRMA, the Income-Related Monthly Adjustment Amount.
IRMAA. I mean, it sounds like a sweet grandmother who brings you hard candies, but it is actually a vicious, extremely unforgiving penalty.
Oh, it is the single most frustrating penalty in retirement planning. IRMAA is an extra surcharge added directly to your Medicare Part B and Part D premiums if your income crosses certain thresholds. And the IRS doesn't use standard AGI for this either.
Of course not.
No, they use Modified Adjusted Gross Income, or MGI.
Okay, let's pause and define that because we just introduced AGI and combined income and now AMAGI. We are just swimming in acronyms today. What is the difference between AGI and AMAI?
So think of your standard adjusted gross income, your AGI, as your base taxable income. But for Medicare purposes, the government wants a truer picture of your total wealth. So they modify your AGI by adding back in certain deductions that you previously took.
Like what?
The most common add back is tax-exempt municipal bond interest. If you have $20,000 of income from municipal bonds, it might be tax-free on your federal return, but Medicare adds it back into your AMGI to see if you can afford to pay more for your health care.
So they're literally padding the stats to push you over the line.
Essentially, yes.
And the truly devious part about IRMAA is the delay. It uses a 2-year look-back period, right?
Yes, it does. For your 2026 Medicare premiums, the government is not looking at what you earn in 2026. They're looking at the tax return you filed for 2024. Whatever your NGI was 2 years ago dictates exactly what you pay for healthcare today.
Wow. You know, think about your tax brackets like a series of increasingly expensive toll booths on a highway. The RMD forces you to drive a massive convoy of cash through those booths all at once, pushing you into the highest tolls. That is the Social Security torpedo.
Great analogy.
But worse, because Medicare IRMAA has a 2-year look-back, it's like getting a speeding ticket in the mail 2 years after you took the trip. You can't even remember the drive, but now your Medicare premiums are through the roof.
That toll booth metaphor is spot on, especially when we talk about the actual mechanics of how IRMA hits you, because unlike the Social Security taxation, which phases in gradually, if 50% gets taxed, then 85% gets taxed, IRMAA is a cliff penalty.
A cliff penalty meaning there is no phase-in. It is binary. You're either over or you're under.
Exactly. Let's look at the 2026 numbers. If David and Sarah's MGI is $218,000 or less, they pay the standard Medicare Part B premium. But if their MGI crosses that line by even one single dollar, if it hits $218,001, they fall completely off the cliff. They do not pay a proportional increase. They instantly trigger an $81.20 monthly surcharge per person for the entire 12 months of the year.
I want to make sure the listener really grasps this because the math is brutal. David's RMD pushes his MGI to $218,001. That one extra dollar of income over the line triggers an $81 surcharge for him and an $81 surcharge for Sarah.
Yep.
That is $162 a month. Multiply that by 12 months, and that one single dollar just costs them almost $2,000 in extra Medicare premiums for the year.
It is effectively a 200,000% marginal tax rate on that specific dollar, and there are multiple IRMAA cliffs. If you go over the next threshold, the penalty doubles. Go over the next, it triples. An uncontrolled flow of taxable income from your 401k doesn't just raise your income tax, it damages the entire financial structure of your retirement plan.
So the obvious question is, how do you stop the convoy from hitting the highest toll booths? How do you control this taxable income if the IRS is mandating these huge withdrawals? Because you clearly can't just have all your money sitting in a traditional 401k.
Yeah, you can't.
Here's where it gets really interesting. We need to introduce part 2 of our deep dive, the 3-bucket strategy.
Right. If you want to survive the tax torpedo, you cannot have all your wealth sitting in one type of account. You need tax diversification. You need options. The Savvy and Ameriprise reports break this down beautifully into 3 distinct buckets, categorized entirely by how the IRS treats the money inside them.
Let's clearly define these buckets so we have a shared vocabulary moving forward. We will start with bucket 2, which we will call the tax-deferred bucket. This is the one we have been talking about, your traditional 401k, your traditional IRA, your 403b.
Right, the pre-tax money.
Exactly. You put the money in pre-tax, meaning you got a tax deduction during your working years. The money grows tax-deferred. But the trap is, every single dollar that comes out of bucket 2 is taxed as ordinary income.
Correct. And bucket 2 is subject to those mandatory RMDs at 73 or 75. Now let's contrast that with bucket 1, the tax-free bucket. This includes Roth IRAs, Roth 401ks, and health savings accounts, or HSAs.
The holy grail.
Truly. With a Roth, you paid the taxes up front. You took a hit during your working years. But in exchange, all the growth and all the qualified withdrawals you make in retirement are 100% tax-free. And crucially, if you are the original owner of a Roth IRA, there are absolutely no required minimum distributions. The IRS never forces you to take that money out.
I love bucket 1. It is the ultimate shield. And finally, we have bucket 3, the taxable bucket. These are your standard brokerage accounts, joint accounts, high-yield savings, or even just real estate.
Yeah.
You funded these with after-tax money. You didn't get a deduction.
Right.
You pay taxes on the dividends and capital gains along the way every year. But the superpower of bucket 3 is flexibility. There are no age limits, no early withdrawal penalties at 59.5, and 0 RMDs.
Understanding the distinct mechanics of these 3 buckets is absolutely foundational, but where retirees get into massive trouble is the sequence in which they choose to drain them. There is this deeply entrenched conventional wisdom in retirement planning that has been preached for 40 years.
What's the standard advice?
The standard advice was always simple. Spend down your taxable bucket 3 first, let your tax-deferred bucket 2 grow for as long as possible, and save your tax-free bucket 1 for the very end, perhaps to cover late-life medical care or to leave to your heirs.
You know, it sounds so logical. If I'm sitting at my kitchen table, why would I touch the accounts that have tax advantages when I can just spend my regular brokerage money? I want to let the magic of compound interest work on the tax advantage stuff as long as possible.
It sounds incredibly logical until you actually run the 30-year projections. Studies from both Michael Kitz's and T. Rowe Price highlight a catastrophic flaw in this conventional wisdom. They refer to the resulting disaster as the RMD tsunami.
The tsunami follows the torpedo. We are really stacking the maritime disasters today. But let's walk through why the conventional wisdom fails.
Think about the timeline if you follow the conventional advice. Let's say you retire at 62. For the next 11 years until you turn 73, you live entirely off your taxable brokerage accounts. During that decade, you feel like a financial genius. You are in a very low tax bracket because you are just spending down your principal, which isn't taxed, and maybe paying a tiny bit in capital gains. You might be paying 0 federal income tax for a decade.
Which sounds like the absolute dream, beating the IRS for 10 solid years.
It does. But meanwhile, your traditional IRA bucket 2 has been sitting there, compounding and growing untouched for over a decade. It doubles in size. By the time you hit age 73, that balance has swelled to a gargantuan number. And then the RMDs begin.
Oh, no.
The IRS looks at that huge balance and forces you to withdraw a significant percentage of it.
And because the balance is so artificially bloated, the forced withdrawal is massive.
Exactly. That massive forced withdrawal acts as the tsunami. It launches you out of your 0% tax bracket and straight into the highest tax brackets of your life. It triggers the tax torpedo, instantly taxing 85% of your Social Security, and it pushes you over multiple IRMAA cliffs, permanently increasing your Medicare premiums.
Just because you waited.
By deferring the taxes for too long, you actually end up paying hundreds of thousands of dollars more over your lifetime than if you had just paid a little bit of tax along the way.
So you win the battle in your 60s, but you completely lose the war in your 70s and 80s.
Yeah.
The alternative to this conventional wisdom is what the TIAA research calls tax smoothing.
Yes. Tax smoothing is the art of blending withdrawals from all three buckets simultaneously to maintain a steady, moderate tax bracket throughout your entire retirement. Instead of having zero taxes for a decade and then crushing punitive taxes for 20 years, you manage your accounts proactively.
Right.
You aim to stay comfortably and permanently in the 12% or 15% effective tax brackets the whole time.
The Kiplinger article in our sources had a phenomenal way of phrasing this. They compared it to crop rotation.
Oh, that's good.
Think about a farmer. If you rely on one single field, let's say, your taxable brokerage bucket, and you harvest it relentlessly every year until the soil is totally depleted, you have nothing left. Then you are forced to move to your tax-deferred field, but it's totally overgrown and unmanageable. Tax smoothing is basically crop rotation for your retirement income.
Exactly.
You pull a little from the tax-deferred bucket, a little from the taxable bucket, and a little from the Roth. You balance the harvest so the ecosystem stays healthy for 30 years.
That is exactly the goal. And a critical component of making tax smoothing work is something called asset location. I want to be very precise here. We are not talking about asset allocation, which is your percentage mix of stocks versus bonds. We are talking about asset location. In which specific bucket are those stocks and bonds physically sitting?
Right. The T. Rowe Price paper goes incredibly deep into this, and it is fascinating. You want to match the tax profile of the investment with the tax profile of the bucket. So you want to keep your tax-inefficient assets inside your tax-deferred bucket, too.
Right. And what is a tax-inefficient asset? Things like corporate bonds, real estate investment trusts, or REITs, or actively managed mutual funds that kick off a lot of short-term capital gains.
Because they generate a lot of ordinary income.
Exactly. Every year, they kick off income. If you hold them in a standard brokerage account, you get bled dry by taxes every April. But if you physically locate those assets inside your traditional IRA, the IRA acts as an umbrella. It shields that annual income from taxes so it can compound efficiently.
And conversely, you want to keep tax-efficient assets, like broad market index ETFs or individual growth stocks that you plan to hold for a decade, in your taxable bucket 3. Why? Because you want to take advantage of one of the greatest hidden gems in the tax code, the 0% long-term capital gains bracket.
I am so glad you brought this up because very few people realize this bracket even exists. We are conditioned to think that all capital gains are taxed at 15% or 20%. But for a married couple filing jointly in 2026, the tax code allows for a massive 0% bracket.
Let me break down the numbers on this because it blew my mind when I read it. If you are a married couple in 2026 and your total taxable income is below roughly $94,000, and remember, that is after your standard deduction, so your actual gross income can be closer to $120,000, you can sell stock in your brokerage account, realize tens of thousands of dollars in profit, and pay absolutely 0% in federal capital gains tax.
Yeah.
Zero. You literally get the profit for free.
It is an incredible opportunity. But here is the catch, and this ties everything back to the RMD Torpedo. That 0% capital gains rate only applies if your other ordinary income doesn't push you over that $94,000 threshold.
The toll booth again.
Exactly. This is why tax smoothing is so vital. If you followed conventional wisdom and you let your traditional IRA grow way too large, the massive RMDs at age 73 will generate so much ordinary income that it will instantly push you over the $94,000 line.
Right out of the bracket.
The RMDs will push you entirely out of the 0% capital gains bracket. You lose that tax-free harvest forever, simply because your bucket 2 was too big.
So by carefully crop rotating and blending your withdrawals, you can pull money out of your 401k up to the very edge of the low tax bracket and then switch over to your brokerage account to pull out tax-free capital gains to fund the rest of your lifestyle. It is a brilliant surgical balancing act.
It really is.
But, and here's the big question, it leads us to a critical real-world problem. What if someone is listening to this right now, they're 62 years old, and they realize their buckets are completely unbalanced? What if 90% of their net worth is sitting in a pre-tax 401k because that is what their HR department told them to do for 30 years, and they can see the RMD tsunami building off the coast? They can't just undo 3 decades of savings. How do they defuse that bomb before the IRS forces their hand?
If you are heavily over-indexed in tax-deferred accounts, you cannot just sit back and wait. You have to play offense. You have to actively rebalance those buckets before the IRS takes control.
Which brings us to part 3, the Roth conversion window. This is the offensive play.
To run this play, you need to understand the concept of the gap years. The gap years are the golden window of time between the day you retire and stop earning a W-2 paycheck and the day you turn 73 or 75 and the IRS forces you to take RMDs. For many people, this is a decade-long window.
Okay, let's look at David and Sarah again. They retire at 62. Suddenly, their income drops off a cliff. They aren't getting a salary anymore, and they are smartly holding off on claiming Social Security until age 70 to let the benefit grow. So for the first time in their adult lives, their taxable income is near zero. They're sitting at the absolute bottom of the tax brackets.
This is the exact moment you execute a Roth conversion strategy. A Roth conversion is just a mechanical process. You are simply instructing your custodian to move money from your traditional IRA, your pre-tax bucket 2, into your Roth IRA, your tax-free bucket 1.
But the IRS is watching, obviously. They don't let you do that for free. You have to pay ordinary income tax on whatever amount you convert in the year you convert it.
That is correct. You are purposefully triggering a taxable event. But the strategy here is what financial planners call bracket topping. You do not convert the whole $1 million IRA at once. That would be disastrous.
Right.
Instead, David and Sarah look at the tax brackets for 2026. They take their standard deduction of around $30,000. They see that the 12% tax bracket goes up to roughly $94,000 of taxable income. They intentionally convert exactly enough money from their traditional IRA to their Roth IRA to fill that 12% bracket to the very brim, say, $93,999, not a single dollar more into the higher 22% bracket.
Okay, I have to push back here on behalf of every listener, because this is the part that always makes people profoundly uncomfortable. Nobody likes paying taxes.
Of course not.
If David has $1 million sitting in an IRA, why on earth would he volunteer to write a $10,000 check to the IRS today? Why wouldn't he just wait 10 years until he absolutely has to? It just feels wrong to pay taxes early.
This raises a really important question, and it is the single biggest psychological hurdle most retirees struggle with. The instinct is always to defer. But mathematically, you aren't paying extra taxes. You are buying your taxes on sale.
Buying taxes on sale. Okay, explain that.
We know two things to be true. First, under current law, tax rates are historically exceptionally low. The Tax Cuts and Jobs Act of 2017 lowered the brackets, but many of those provisions are set to sunset, meaning rates are legally scheduled to go up.
Right.
Second, we know that David's RMDs are going to be massive. If David waits until he is 75, those forced RMDs combined with the tax torpedo on his Social Security might force his effective marginal tax rate into the 30% or 35% range.
So the choice isn't between paying taxes now or never paying taxes. The choice is between paying 12% voluntarily today or being forced by the government to pay 35% a decade from now.
Exactly. You are locking in the known low rate today. You are buying the tax liability on sale. Furthermore, by intentionally moving that money out of the traditional IRA every single year during the gap years, you are actively shrinking bucket 2. You are deflating the balloon before it pops.
Which lowers the RMD later.
Exactly. A smaller traditional IRA at age 73 means smaller future RMDs. Smaller RMDs mean you avoid the Social Security torpedo and you stay safely under the IRMAA cliffs for Medicare.
It is a preventative strike. And let's look at what happens to the money once it is safely inside the Roth IRA bucket. It is glorious. It grows tax-free forever. It is completely immune to RMDs. The IRS can never force you to take it out. And most importantly, returning to our combined income formula, Roth distributions are utterly invisible to the IRS.
They do not exist as far as the Social Security or Medicare formulas are concerned. They do not count toward your AGI, your MAGI, or your combined income.
Let's walk through a scenario from the KISS's research to show how powerful this invisibility cloak is. Imagine David and Sarah did the work. They converted $100,000 into a Roth IRA over a few gap years. Yes, it hurt slightly to pay the tax bill out of their savings at the time, but fast forward 10 years, David is 80. They're living a nice, tax-smoothed life. Suddenly, they need to buy a new car, or worse, they have a massive, unexpected medical emergency that requires $40,000 in cash immediately.
If David had left all his money in the traditional IRA and he had to pull an extra $40,000 out to pay that medical bill, it would be catastrophic.
Because of the ripple effect.
Right. That $40,000 gets added to his AGI. It spikes his combined income, triggering the 85% tax on his Social Security. It spikes his MBI, triggering a 2-year IRMAA Medicare penalty. The true cost of that $40,000 medical bill might end up being $60,000 when you factor in the cascading tax penalties.
But because David did the conversions, he has bucket 1. He pulls the $40,000 from the Roth IRA, he pays the hospital. What happens to his taxes?
Nothing. Absolutely nothing. His taxable income for the year remains exactly the same. The Roth distribution doesn't even show up on page 1 of the 1040. He pays no extra income tax, his Social Security remains protected, and his Medicare premiums don't budge. The Roth bucket is the ultimate financial shock absorber in late retirement.
It is incredible. But, to truly appreciate why manipulating these buckets, and specifically why building up your taxable bucket 3 is so fundamentally powerful, we need to look at the raw head-to-head math. We need to look at what actually happens to a dollar when it leaves a 401k versus when it leaves a brokerage account, because they are not treated equally by the IRS.
Let's move into part 4, brokerage versus 401k math. This is the tactical execution of your withdrawals. The entire decumulation strategy really hinges on contrasting the distinct tax treatments of these two accounts.
Okay, imagine you are listening right now. You are retired, and you decide you need exactly $100,000 in cold, hard cash to fund your lifestyle this year. You want to take a grand trip to Europe, pay off a chunk of your mortgage, and buy groceries. You need $100,000 to hit your checking account. Let's look at scenario A. You decide to pull that $100,000 entirely from your traditional 401k.
In scenario A, the IRS treats every single dollar of that $100,000 withdrawal as ordinary income. It does not matter if the growth inside the 401k came from stock appreciation or dividends or interest. The IRS treats it all exactly the same as if you had earned it working at a factory. It is taxed at your highest marginal rate. If your effective tax bracket is 22%, you owe $22,000 in federal taxes on that withdrawal.
Wow. I pull out $100K, I instantly lose $22K. My effective tax rate on that cash flow is a painful 22%. Now, let's look at scenario B. I listened to this deep dive. I did my tax smoothing. So instead of touching the 401k, I decided to generate that exact same $100,000 by selling stock in my taxable brokerage account, my bucket 3.
This is where the mechanics of capital gains taxation become incredibly advantageous and where the math heavily favors the prepared retiree. When you sell stock in a brokerage account to generate cash, you are not taxed on the entire $100,000 withdrawal. You are only taxed on the gain.
Yeah.
Let's assume you bought a broad market index fund years ago for $80,000. That $80,000 is your cost basis. It is money you already paid taxes on before you invested it. Today, the investment has grown and it is worth $100,000. So your actual profit, your gain, is $20,000.
So when I sell $100,000 worth of stock, the first $80,000 is simply a return of my own principal. The IRS legally cannot touch it. It's completely tax-free cash flow. I only owe taxes on the $20,000 of profit.
Exactly. And it gets better. Because you held that index fund for more than a year, that $20,000 profit is not taxed at ordinary income rates. It is taxed at long-term capital gains rates, which the government purposefully set significantly lower to encourage investment. For most middle-class retirees, the long-term capital gains rate is a flat 15%. So you pay 15% tax, but you only apply that 15% to the $20,000 gain.
Wait, let me run these numbers out loud so I'm not missing a trick here. 15% tax applied only to the $20,000 of profit. 15% of $20,000 is $3,000.
That is the big reveal right there. Let's compare the two scenarios. To put the exact same $100,000 of spending power in your pocket, scenario A, the 401k, costs you $22,000 in federal taxes. Scenario B, the brokerage account, costs you $3,000 in federal taxes. By using bucket 3, your effective tax rate on that $100,000 cash flow is just 3%.
22% versus 3%. That is a $19,000 difference for the exact same lifestyle. This is why having all your money trapped in a 401k is so incredibly dangerous. People think a 401k is safe, but it is actually the most expensive place to pull money from in a retirement. And the brokerage account gets even more powerful if we look at the legacy aspect, if you never sell that brokerage asset at all.
This is perhaps the most critical wealth transfer concept in the entire U.S. tax code. It is a provision called the step-up in basis.
Hold on. I want to stop and make sure the listener really grasps this, because when I first learned about this, it sounded like a loophole that couldn't possibly be legal. It is the closest thing to a magic trick in finance. Walk us through how the step-up in basis works.
It is entirely legal and explicitly written into the tax code. Let's say you bought an asset in your taxable brokerage account, say shares of Apple stock, or even a rental property 30 years ago. You bought it for $50,000. Over the decades, it has exploded in value. On the day you pass away, it is worth $500,000.
So there is $450,000 of pure unrealized capital gains sitting there. If I had sold it the day before I died to pay for nursing home care, I would owe a massive capital gains tax bill on that $450,000 profit.
Precisely. But if you hold on to it, and you leave that asset to your daughter in your will, the IRS executes a step-up in basis. The moment you die, the IRS permanently forgives the tax on that growth. They actually step up the cost basis from your original purchase price of $50,000, and they reset it to the market value on the day of your death, $500,000.
So my daughter inherits the stock. Her official IRS-recognized purchase price is now $500,000 if she logs into the brokerage account the very next morning and sells the entire position for $500,000.
She owes exactly $0 in capital gains taxes. The $450,000 of growth that occurred during your lifetime is wiped clean. The step-up in basis legally erases a lifetime of accumulated capital gains taxes forever.
So what does this all mean? It completely shatters the myth that having a massive taxable brokerage account is a bad thing. People are always complaining, oh, I'm paying taxes on mutual fund dividends every year. This bucket 3 is so inefficient. But when it comes to actual decumulation, the brokerage account is a weapon.
It absolutely is.
It provides incredible cash flow flexibility. It gives you access to the 0% capital gains brackets. And it is the single most powerful legacy transfer tool in the tax code. It is vastly superior to a bloated 401k that is just going to force ordinary income upon you and your heirs.
It is a paradigm shift for a lot of people, but as tax strategists, we have to acknowledge reality here. The strategies we've discussed so far, tax smoothing, executing Roth conversions during the gap years, letting brokerage accounts grow for the step up in bases, these all require time. They are proactive strategies best executed in your early 60s. What if a listener is sitting here, they're already 74 years old, the gap years are gone, the RMDs have already started, and the tax torpedo is currently locked onto their Social Security? They're taking on water right now. What do?
Is there an emergency exit? Yes, there is. We are moving into Part 5, Advanced Evasion QCDs and State Lines. If you are over 70 and a half, the IRS offers you a very specific, highly effective tool called a Qualified Charitable Distribution, or QCD.
A QCD is a provision that allows retirees aged 70 and a half or older to transfer funds directly from their traditional IRA to a qualified 501c3 charity, and the limits are generous. For 2026, the inflation-adjusted limit for a QCD is $111,000 per person per year.
Okay, let me play devil's advocate for a second. Why is a QCD better than just taking the RMD money out of my IRA, putting it in my personal checking account, and then writing a check to the Red Cross or my local food bank myself? I'm a generous person. I'd get a charitable deduction on my taxes either way, right?
Not necessarily, and this is where the mechanics of the 2017 tax reform changed everything. Because the standard deduction was raised so significantly, it's over $30,000 for a married couple over 65. Now, the vast majority of retirees no longer itemize their deductions. They just take the standard deduction.
So if I write a $5,000 check to a charity from my checking account, but I don't itemize, I get absolutely zero tax benefit for that donation. I gave away the money, but I still paid taxes on the IRA withdrawal that funded it.
Exactly. You are literally paying taxes to give money away. But the magic of the QCD is how it bypasses that entire system. The sources emphasize something called the first dollars out rule. What this means is that if you instruct your IRA custodian to send the money directly to the charity, the check is literally made out to the charity, not to you. That distribution fully satisfies your RMD requirement for the year, up to the amount given.
Right.
But crucially, the money never touches your tax return.
Explain that. How does it not touch the return if it came out of the IRA?
Because it is a direct transfer to a qualified 501c3 organization, it is completely excluded from your gross income for federal tax purposes. It never enters the top line of your Form 1040.
And because it never enters the top line, it bypasses the adjusted gross income.
Exactly. Because it skips the AGI entirely, it never gets factored into the combined income formula for Social Security taxation. It never gets factored into the MAGI calculation for Medicare IRA surcharges. It is the ultimate shield against the tax torpedo. If you are philanthropically minded and you are being crushed by RMDs pushing you into higher brackets, the QCD is the single most efficient way to lower your tax profile and fulfill your charitable goals simultaneously.
Let's visualize that. You give $10,000 to your favorite charity via QCD. You instantly satisfy $10,000 of your required RMD from the IRS. The charity gets the full $10,000, and your taxable income doesn't go up a single cent. No Social Security torpedo, no IRMA cliffs. It is a win-win-win.
Truly an amazing tool.
But there is one more advanced maneuver we need to discuss, and it doesn't involve the IRS at all. It involves looking at a map of the United States.
State taxes. They're often the silent, completely overlooked killer in retirement plans. You can execute a flawless federal tax strategy. You balance your three buckets perfectly. You manage your capital gains. You do your QCDs. And you can still lose thousands of dollars a year simply because of the geographic coordinates of your house.
Our sources from Protect and Preserve Inc. actually mapped out the 2026 state tax landscape, and it is a total minefield. Did you know there are 12 states that actively tax Social Security benefits? States like Colorado, Connecticut, Minnesota, Rhode Island, New Mexico. If you live in one of these states, the tax torpedo isn't just a federal problem. It hits you at the federal level and the state level. They are double dipping on your benefits.
Meanwhile, you have states like Florida, Texas, Nevada, and Tennessee that have no state income tax at all. Everything you pull out is state tax-free. But there is also a fascinating middle ground that people frequently ignore. There are states like Illinois or Pennsylvania that have a relatively high income tax for working professionals, but they fully exempt Social Security and almost all pension or IRA retirement income.
That is wild to me. So you could live in Illinois, pay high property taxes, but pay zero state tax on your $1 million IRA withdrawals.
Yes. The variation between states is massive. So moving across state lines, especially before you claim Social Security or before you begin massive IRA distributions or Roth conversions, is a legitimate high-impact strategic maneuver. It isn't just about retiring where the weather is warm. It is about geographic arbitrage to protect your margins.
We have covered an immense amount of ground today. We have taken 30 years of dense tax code and really distilled it. Let's do a quick recap of the journey. We started by identifying the hidden danger of the RMD torpedo, how forced withdrawals from your traditional 401k can cause a cascading double blow by artificially spiking your combined income to tax your Social Security and jacking up your MAGI to trigger Medicare IRMAA premiums.
And then we looked at the defense mechanism, the three-bucket strategy. By deliberately balancing tax-deferred, tax-free, and taxable accounts, you can engage in tax smoothing. You blend your withdrawals to stay in lower tax brackets throughout your entire 30-year retirement, rather than suffering the RMD tsunami.
We discussed going on the offense during the gap years with bracket topping, using strategic Roth conversions to intentionally buy your taxes on sale before RMDs begin. We broke down the math to prove the absolute dominance of long-term capital gains in a brokerage account compared to the punishing ordinary income rates of a 401k. And finally, we looked at the emergency exits for those already over 73, utilizing QCDs to bypass AGI entirely and relocating to tax-friendly states to avoid the double dip.
I want to reiterate a core belief here as we wrap up. All of the information we have unpacked today, all of the rules and formulas are entirely useless if they just sit in a notebook somewhere. Knowledge is only valuable when it is applied.
Absolutely.
You now have the strategic framework. You understand the rules of the game and why those rules were written the way they were. It is up to you to look at your own accounts, perhaps consult with a fiduciary planner who understands tax-efficient decumulation, and structure your withdrawals so that you, and not the government, control your wealth.
We spent this entire deep dive talking about your life, your taxes, your RMDs, your Medicare premiums. But let's leave you with one final provocative thought to mull over, something that goes beyond your own lifetime. We briefly touched on the step up in basis, but what happens to the money in bucket two? What about your kids?
Yes. The legacy aspect of the Secure Act. This is the final trap.
In 2019, Congress passed the Secure Act, and they quietly killed something called the Stretch IRA. If you leave a massive, unconverted traditional IRA to your children today, the rules have changed drastically. Under the 10-year rule, your kids are legally forced to drain that entire inherited IRA within 10 years of your death.
And think about the causality here. Think about when they will inherit it. If you pass away in your late 80s, your children are likely in their late 50s or early 60s. They are in their absolute peak earning years.
Exactly. They're at the absolute height of their careers. They might be executives or senior managers already sitting in the 24% or 32% tax bracket based on their own salaries. And suddenly, because of the Secure Act, they're forced to take massive, fully taxable distributions from your inherited traditional IRA and stack that income directly on top of their own salary. Congress designed this rule specifically to accelerate tax revenue from inherited wealth.
You could be subjecting your hard-earned life savings to the highest marginal tax brackets in existence. Between federal taxes, state taxes, and the impact on their own tax profile, your children might lose 40% or 50% of your legacy simply because the money was left in the wrong bucket.
This is why taking control of your decumulation, balancing those buckets, utilizing Roth conversions during your gap years, and leveraging the step-up in basis on your brokerage accounts is so vital. Tax-efficient decumulation isn't just about maximizing your own spending in retirement. It is the ultimate act of protecting your family's legacy. It ensures that the wealth you spent 40 years building actually goes to the people you love, not to backfill the 1993 tax thresholds.
It's all about control.
It really is. So as we close this out, think about your financial architecture. Retirement planning isn't a single clean equation. The rules are murky, the laws shift, and the math is highly sensitive. But with the right strategy, you don't need to be a CPA. You just need a good compass, multiple buckets, and a proactive plan to navigate the currents. Thank you so much for joining us on this deep dive into the sources. Take these insights, look at your own statements, and take permanent control of your financial future.